Hello everyone, today we come back and look at my experiment again. When we start this, we spent about 32,000 on Solana. It's a high risk asset, and we bought about 400 like share. And in May it went to like 97, and I sold some at 96, and I make about $6,000. And in June, when it come back to like 60, I will lost about $8,000 loss, I think. So it was $8,000 loss. But now it come back to 76. Let's see, Solana now 76.9. Even come more, down a little bit more, but now I only lost $1,600 or $1,700. Altogether about $7,700. But it's a risky. It's a risky asset, so that's why the price is so volatile. And at the end of this month, right now I'm increasing my expectation a little bit because it already hit 77. So now I'm increasing my projection. It might be 80 and 85 and 90 and 99. So when it go there, when it hit 99, if at the end of the year it hit 99, I think I make about $7,000 or 21% return. And Solana right now it's about 582 million share circulation, and the market cap is about $44 billion. And today Solana went up in the same thing as Ethereum, same thing with Bitcoin. But for the stock market, we see PKW have ETF have 100 company that use their free cash flow to buy back their share. So when they buy back their share, they make the stock price increase. And we see today, even though everybody in the red, it's still in the green. Same thing, S&P 500 also in the red, down about 0.7%. Dow Jones Industrial down about 0.2%. Nasdaq Composite down about 1.33%. Gold also down about 1.88%. Crude oil today, let's see, crude oil today is a little bit up, only like 84. It was 85 and came back down and going back up. So, but yeah, crude oil today go up a little bit because when the market opened, it was about 83. And SpaceX today also come down, went up to 145 and come back down to 142. And the rate today, we see the 30-year coming back down to 5.284. So it come down from over 5.2. 10-year 5.710. And 3-year rate, 1 month rate is 3.690%. So this is a good news because the interest rate coming back down, because everybody were worried that if the interest rate keep going up. But I think the Fed, they actually monitor that really close and they don't want it to go out of control. The Fed usually they take care of like short term, only take care of the short term T-bill. However, if they need to, they also can do something to affect the long term Treasury yield also. But it's not go out of control. So it might be because the Fed intervene, or might be the market do the correction. Either way, it's good news today with the interest rate. Let's see a deeper look at today's finance news. Today, August 18, 2026. And what I think matters most for investor. Bond market is the biggest story today. The 3-year Treasury yield briefly hit 3.3371%, its higher level since 2007. By later in the session, it had eased to about 2.28%, while the 10-year was around 4.71%. Several forces are pushing long-term yield higher, like federal borrowing needs, inflation risks from expensive energy, concern about demand for treasuries, and extraordinarily heavy corporation borrowing to finance AI infrastructure. Reuters notes that higher treasury yields fit directly into mortgages, corporate borrowing, government interest costs, and equity evaluation. Why this matter? A 5% plus long bond becomes serious competition for stocks. An investor can earn a substantial yield without accepting equity market risk. That particularly hurt companies whose valuation depend heavily on profit expected many companies from now. So this one, I think they mean like when the company profit, they forecast like 10 years into the future, and when the interest rate higher, so they use that rate to calculate the present value. So they use the free cash flow to calculate the present value, because the rate higher, so the present value is lower. I think that phrase, that's what it means. My interpretation, this is more important than today 1 to 5% move in individual technology stocks. If 30-year yield keeps moving toward 5.4 or 5.5%, I would become increasingly cautious about high multiple growth stock. To AI semiconductor stock experience major sell-off. Nasdaq fell 1.33%, semiconductor stock were much weaker. Nvidia declined 2.3%, Broadcom 3.2%, Micron 7%. Semiconductor Index fell roughly 5 to 5.6% during today's session. The Semiconductor Index is about 30 company, 30 company that semiconductor company. This isn't necessary. Investors suddenly deciding AI is worthless. The problem is a combination of exceptionally high AI stock valuation, huge capital spending requirements, increased corporate borrowing, higher discounted rate, the profit taking after enormous semiconductor gains. Allied technology companies, including Alphabet, Amazon, Microsoft, and Meta, are collectively expected to spend more than $730 billion this year, much of it associated with AI infrastructure. That creates an important question for investors. Will AI profits grow fast enough to justify the enormous capital being invested? That question is starting to matter more than simply whether AI usage continue growing. 3. Today, decline look more like rotation than panic. So far, the closing number was S&P 500 7,691.76, down about 0.69%. Nasdaq 26,289.71, down 1.33%. Dow Jones Industrial 53,343.40, down 0.22%. The interesting part is the difference between Nasdaq and Dow Jones Industrial. Technology will hit much harder than the average company. That suggests investors are rotating away more expensive AI growth stocks rather than indiscriminately selling everything. That distinct matter. The true risk of panic would typically show broader weakness across the financial, industrial, small caps, summer consumer stocks, and credit markets. For now, I would call this a valuation rate-driven correction rather than market crash. 4. Oil about $90 per barrel could become the bigger inflation problem. Brent crude closed at 91.02, while WTI closed around $84.94 per barrel, their highest close since July 24. The driver is renewed concern about U.S.-Iran conflict and potential disruption around the Strait of Hormuz. Oil matters well beyond gasoline. Higher energy price eventually affect transportation, manufacturing, agriculture, airline cost, shipping, consumer prices. That means $90 oil could complicate the Federal Reserve's job. The dangerous scenario would be oil go up, inflation expectation go up, Treasury yield go up, the Fed stay restrictive, stock value come down. That's a change I would watch. So I think this already went up, Treasury yield already went up, but the Fed doesn't do the restrictive yet, so all eye is on the Federal Reserve right now, and the stock actually come down today, so you can watch all together with that. And the Federal Reserve is caught between inflation and economic weakness. The Fed currently have it benchmark at 3.50% to 3.75. So yeah, so it's still below 3.75, so it's still around the Fed target. So the following July meeting. The problem is recent economic signal points in opposite direction. On one side, softer employment, weaker retail sales, weaker housing activity, softer than fear inflation, though argue to keep the rate unchanged or eventually easing. On the other side, oil near $90, inflation still above the target, rising long-term yield, geopolitical supply risk, though argue against cutting. Reuters poll published yesterday found that a long-term majority of economy expects for the Fed to hold rate at 3.5% to 3.75% through the end of 2026. July Fed meeting minute come out Wednesday, making them one of the next major market catalysts. What I look for is any language suggests officials are increasingly worried about oil-driven inflation. Housing is showing real stress. July total housing start dropped 12.4% to annualize 1.239 million units. Single family start dropped 9.9% and were down 15% from a year earlier. Pending existing home contract, it fell 2.3%. Mortgage rate around 6.77% remain one of the key reasons. Consider what this means mathematically. Buyer borrow $400,000, around 3% pay dramatically less monthly interest than borrow borrowing that amount around 6.8%. Eventually, its home price don't rise, affordability deteriorate. That limits home purchases, construction, furniture, appliances, renovation, housing-related employment. Housing is therefore tell us monetary conditions remain tight. Home Depot actually produced a respectable quarter. Home Depot reported Q2 revenue of $47.86 billion, up 5.7%, exceeding expectation of roughly $47.27 billion. Adjusted earnings per share were 4.92% versus approximately 4.73% expected, so about 20 cents more per share. U.S. comparable sales increased 1.3%, while overall comparable sales rose to 1.7%. What interesting is where demand is coming from. Consumers remain cautious about huge remodeling projects, but they still spending on maintain, repair, and smaller projects and professional contractor needs. So Home Depot's number don't necessarily mean housing has recovered. They suggest existing homeowners are maintaining property rather than moving into a new one. Manufacturing has one powerful bright spot. AI infrastructure despite housing weakness. U.S. infrastructure output increased 0.2% in July. Even more interesting, semiconductor output climbed 2.4%. That illustrates an important contradiction in today's market. AI economy itself remains strong while AI stocks are falling. Indicator and investors are not necessarily question whether companies are building data centers. They question how profitable will those investments ultimately be. That's much more sophisticated concern. 9. Gold falling despite geopolitical risk is an important signal. Gold dropped about 1.1%, with spot gold near $4,365 per ounce, as rising bond yield overwhelmed some of the safe haven demand. This is exactly what we expect when yield rise dramatically. Gold doesn't produce interest. So when Treasury yield rise toward 5% plus, owning bond becomes relatively more attractive. That is why today commodity. That is why today's a combination of increasing oil price, Treasury yield increase, and plus gold decrease is particularly interesting. The bond market is dominating asset pricing. 10. This has important implications for crypto. This is where today finance news become particularly relevant for Bitcoin and Solana. Crypto typically performs best when liquidity is expanding and real yields are falling. Today's environment is almost opposite. Treasury yield increase, dollar relative firm, or increase interest rate, risk increase, tax decrease, risk appetite decrease. They're generally short-term bearish for crypto. But there's an important distinction. If the economy is slow enough that investors begin expecting the Fed to cut rates, Treasury yield could eventually fall. That could become significant bullish catalyst for Bitcoin, Solana, and technology stock. So for Seoul specifically, I would pay more attention. I would pay almost as much attention to 10-year Treasury yield as Solana's own chart right now. My market dashboard. I would currently rate signal approximately like this. Indicator 30-year yield about 5.28% bearish, high borrow cost. 10-year yield 4.71% bearish, pressure on growth valuation. Brent $91 bearish because inflation risk. Fed policy neutral, likely hold. Housing weak, economic slowdown signal. Manufacturing positive, AI investing happening. AI semiconductor correction, valuation reset. S&P 500 caution still near high. Nasdaq Composite 100, short-term bearish, tax under pressure. Crypto caution, short-term bearish. I don't know. I cannot tell the color. Sensitive to yield. What would make me bullish again? The first thing I want to see is 10-year Treasury falling back below roughly 4.6%, followed by 30-year moving decisively below 5.2%. Then I want oil to fall below $85 for Brent cruise. If that happens while economic growth remain intact, the environment becomes much more favorable for Nasdaq, AI stock, Bitcoin, and Solana. Conservatively, if a 30-year move about 5.4% to 5.5%, Brent move toward 100, I would treat that as a signal warning that the equity crypto correction would deepen. The two market Treasury, those two markets, Treasury and oil, are the ones I would watch more closely over the next several days. Hi everyone, thank you for watching today. I think that's all I have for today. My Solana, it looked like we have today is supposed to be bear market, but crypto doing really well today. I really don't know why, but the price is like, we already know that at the end of the year the price will be $100. So the day-to-day price it's just the distraction noise. So don't worry about that too much, and just wait until the end. And also, we also know that in the long run it will come back. It take maybe 1 or 2 years, but we know that we're coming back. So don't worry about too much about day to day, just worry about the destination. All right everyone, thank you for watching. Bye bye.